ETF 98.5. VIX 15104.45%. 25%, 35%, 40%. /ZH. N. Good evening, everyone. Today's market action presented a nuanced picture, with some significant underlying tensions. Let's dive straight into the closing numbers. The Nasdaq 100, as reflected by the QQQ ETF, closed up 0.96% at 674.15 points. The S&P 500, through the SPY ETF, also saw a modest gain of 0.28%, finishing at 720.65 points. While major indices showed gains, it's crucial to note that the VIX Volatility Index simultaneously climbed 0.59%, settling at 16.99, which in itself signals internal market contradictions. Meanwhile, the 10-year U.S. Treasury yield fell 0.27% to 4.38%, and the U.S. dollar index DXY edged up 0.06% to 98.21. In commodities, WTI crude oil took a significant hit, dropping 2.81% to $102.50 per barrel, and spot gold also dipped slightly by 0.28% to $4,625.60. However, Bitcoin bucked the trend, surging 2.47% to over $78,135. Today's strongest performers were undoubtedly cryptocurrency-related stocks, with MicroStrategy, MSTR, soaring 7.08%, and IBIT gaining 2.65%. The weakest sector, as we observed, was energy. Overall, the nature of today's market for U.S. equities and global risk assets appears to be a bull trap reversal, with a high probability of 70%. On the surface, the market was lifted by tech stocks, but its internal structure proved extremely fragile, exhibiting a classic indices up, fear up divergence. This is not a signal of broad capital reallocation to risk assets, but rather a highly concentrated inflow into a singular speculative narrative led by cryptocurrencies, while other asset classes generally displayed a flight to safety tendency. Let's recap the global market trajectory. Asian markets were subdued, with China's A-shares maintaining a narrow trading range throughout the day, the Shanghai Composite barely up 0.11%, and the Shenzhen Component down 0.09%. They failed to set any clear tone for global markets. European markets, though lacking specific index data, likely also experienced indecisive, range-bound trading. However, after the U.S. market opened, the afternoon session became a distinct turning point for global markets. Capital, seemingly ignoring macro risk signals, launched a targeted assault on specific sectors. Crypto-related stocks, exemplified by MSTR's 7.08% surge, became the emotional leaders, pulling high-beta tech stocks like Tesla higher and ultimately pushing QQQ and SPY into positive territory. Yet, the sharp decline in crude oil, representing broader macroeconomic demand concerns, was selectively overlooked by the equity market. This market movement reveals significant expectation gaps. Two major bearish signals were disregarded. First, the 2.81% plunge in WTI crude oil, a strong indicator of slowing global economic demand, and second, the VIX Fear Index rising 0.59% even as equity indices advanced. Ignoring these clear bearish signals suggests that current market sentiment is driven by short-term speculative momentum rather than fundamentals, indicating a market structure that is strong but highly unstable. If one had assumed a broad return to risk appetite this morning, that would have been a significant error, as the market's true condition is a coexistence of structural frenzy and systemic concern. For instance, Nvidia actually closed down 0.56%, illustrating that even within the tech sector, capital flows are highly fragmented. A new structural signal has emerged today, with a 75% probability. The emotional influence of the cryptocurrency sector has elevated to a point where it can independently guide the Nasdaq index, even against macroeconomic headwinds. It's no longer just a risk appetite thermometer for the market, but has become an engine capable of actively generating market sentiment. Let's examine the triple interplay between currencies, equities, and bonds. Today, they exhibited extreme divergence. Equities, SPY, rising suggested increased risk appetite, while both bonds, 10-year U.S. Treasury yield falling, and currencies, DXY rising, pointed to risk aversion. This rare, three-body problem type of divergence means internal market contradictions have intensified to an extreme degree. It implies significant uncertainty for Asian markets tomorrow. Asian markets might open higher, tracking U.S. equity gains, but a strong dollar will immediately exert capital outflow pressure, potentially leading to a divergent or weakening trend after the open. From a trading perspective, chasing the opening gains in Asian markets should be avoided. Looking ahead to tomorrow, Asian markets are likely to experience a high open, then fall, or wide-ranging volatile session. Markets like the Nikkei and Kospi will digest the positive U.S. equity close, but a strong dollar and weak macro signals, like crude oil, will continue to exert pressure. We believe the energy sector, after its almost 3% single-day plunge, might be technically oversold and ripe for a rebound. If there are no further macro-bearish developments overnight, or if any geopolitical tensions emerge in the Middle East, a recovery window for the sector could open, with a probability of about 55%. Furthermore, as it's Friday, we must be vigilant about potential geopolitical risks escalating over the weekend. Additionally, if U.S. non-farm